Hi, this is Todd with Integrity Investment Advisors. Here is a blog update for clients and people who follow us. We've had some volatile markets here recently, so I want to go through some core themes of how we build portfolios. So, asset allocation 101, how to balance risk and reward for long-term growth. And you can pause any of these slides. I'm going to go sort of fast, but the answer to this normally is financial planning. It helps tell us how much risk you need to take to hit your goals and cash flow and modeling in retirement, and if you're on track. So for the agenda here, it is March 11th, just so we know. We're going to go over how we build portfolios. We're going to go over, do we want more diversification or less? Are we playing offense or defense? Are markets cheap or expensive? And if you have questions or want a second opinion, you can schedule a call to review your plan here. So this is a great slide, and basically it's about the power of time in markets. So if I were to come to you and say, hey, we should buy, and we just had really bad timing, we should buy the day before the 1987 crash where it fell 33%. Here are the returns from that date, just the day before. 10% for equities, 5.4% for bonds. Right before the 2000 dot-com bust, better for equities, less for bonds. Right before the financial crisis, better for equities, less for bonds. This number is actually less than inflation. How about right before COVID? Better for equities, less for bonds. The key to long-term investing is investing in equities and being able to weather and withstand the volatility. That's why we get paid, and that's how we help clients. So again, here's a great chart. January 1st, 2020. If you had, let's just say, $1 million and you said, hey, I'm worried there might be a global outbreak that shuts down the world and has high inflation. Should we invest in equities or safer bonds? Well, the answer is a resounding, we should invest in equities. Even though they go down quite a bit in March, they tended to rally. So the S&P 500 over this period was up 88%. We have some other strategies that were up 55 to 65%, sort of in the middle here. And bonds, if you put $1 million in bonds, it barely returned, less than 1%, and trailed inflation by a lot over that period. So again, most of the time, if you don't need the money in the next 5-7 years, you want to invest in equities. Here's another example in the lows of 2009. If you invested $1 million in equities, just the S&P 500, it's up about 10x, 1,000%. If you invested in the U.S. bond market, aggregate bond market, it's up 53%, okay? Sounds okay, not nearly as good as equities, but inflation's up 50%. So you're barely keeping track with inflation over a 16-year period, okay? And there's always reasons to be afraid. So the latest is a new regime with Trump and trade wars and tariffs, and we're down maybe 9.5%, 10%. I'm sort of hoping we get to at least 10%, but we'll see. But this is the 30th time this has happened since 2009. It lasts on average, 26 days, and on average, down about 8%. So there's always something to be worried about in the short term. And this is why we do have bonds, is to weather these pullbacks, provide opportunities for buying more at some point in time. Here's another slide. As we get out into 5 and 10 year time frames, returns for equities are positive 88 to 95% of the time. And we look at rolling 10-year periods to give you even more confidence about it. 85% of the time, the returns are greater than 7%. So that's important. Half the time, they're greater than 13%. If you take it out to 20 rolling year periods, 466 periods, overlapping periods, 93% of the time, it's greater than 7%. For each year of the 20 years, half the time it's better than 10%. So again, we want to own equities for a decent part of your portfolio. And the way we think about it is if you need the money in the next, say, 7 years, it should be in something else. Okay, we go to 7 or 8 years, 95 to 97% positive returns. If you need something in the next 2, 3, 5 years or so, it should be in something safer. And that's how we have our portfolios constructed. And then this slide is really key, so I'm going to take a quick second on it. So we actually liability match how much you need in your shorter term buckets. And this could be 4, 5, even maybe up to 7 years if you're super conservative. And then after this time, this is only returning nominal returns of 4, 5, 6%. So with inflation at 3%, and taxes, you're really not growing this money. It's there for safety. It's there for cash flow. We call that liability matching. The rest of your portfolio should really be invested in these two buckets. So we have a middle bucket where we do some hedging and some risk mitigation tools, more diversification with AQR, JP Morgan, maybe private credit. And then this is long only equities from that standpoint. So this is how we build most of our portfolios. Every dollar you invest should have a job and a time frame, okay? And diversification helps. So should I should I change my investment strategy? And we need to think about several things. Are we playing offense, risk on, or defense, and we want more diversification? And we need to design this for your portfolio with your planning software, okay? We take into consideration market valuation, okay? Are we expensive versus history? Yes, we probably are. And then we overlay tax savings, reducing capital gains, Roth conversions. This is a big driver of total returns and the money you keep after taxes. So that's very important. And then here's how we think about investing. The core of your retirement plan in investing is your health and good investing behavior, not bailing when we have a 5, 10, 15%, even 20% downturn. So this is the core. And then we look at cheap indexing. We call that beta for global stocks and bonds. We look at factors, which is high quality and profitability and momentum. We look at macro bets with technology and AI and software. Again, very good returns over long periods of time. And the very top are some risk mitigating strategies. A lot of times this is really for clients with $1 million or more. We have some long short strategies. We have some private credit. We have some JP Morgan strategies. If you have less than $1 million, you probably just need these core components of the portfolio. So here's another slide. Sometimes people think that they're diversified, even if they have a 50-50 portfolio or a 60-40 portfolio. And you are to some degree. I mean, we do like that. However, most of the risk comes from equities. So you look at this as about 80% in a 50-50 portfolio, 86% in a 60-40 portfolio. So when the markets go down, your portfolio is definitely going to go down. Bonds and some other diversifiers cannot save you from the equity risk that you're taking in the portfolio. So we want to be diversified, and most of our clients probably have maybe 40% in equities up to 70 or 80% in equities, depending on your age and your goals. All right, so if you want to set up a call, you can book on my meeting, or if you're a potential new client, you can book a second opinion meeting with us where we'll run through your portfolio. We can talk about our base case for the year. We are expecting more volatility. Markets are a little bit expensive compared to history. We don't think we'll have a recession in the next 12 to 18 months. We will have some volatility. We talk about how much diversification you want. Are we playing offense or defense? And then really this is planning software. How much risk do you need to take to hit your goals? And as you build a larger portfolio and you're in retirement, it might be that you can and want to take less equity risk and still have a great retirement from that standpoint. Here's a key one. We really want a real return above the rate of inflation, net of all fees and net of taxes. We talk about how much is enough, how big a portfolio, how much cash flow. And then no matter what, you're always going to have a maximum regret and a minimum regret. If markets go to the moon and just keep ripping up, you're going to wish you had more equities. If there's volatility and equities go down, you're going to wish you had more bonds and more diversifiers. Okay, here's some other great examples. Again, you can pause any of these, but Warren Buffett says, be greedy when others are fearful. Okay, so here's a quarterly drop of 15% or more. It has happened quite a few times over these periods. And you can see the next quarter, next 6 months, next year are all pretty good after we have times of volatility. And this is a 2-quarter drop of 20% or more. So again, very high win rates, good returns, 20+% a year later. So volatility is something we have to deal with to get those good long-term returns. Here's another great slide going back to 1974, 51 years. We've had 20% down years. The average return on those down years is down 14%, okay? And then 41 up years, 80% of the time. And the average return is 19%. So we don't have averages like 10, 11, 12%. If we're not in a drawdown or a recession, markets tend to have pretty good returns over time. And we want compounding over decades, net of all fees, for that long-term bucket. Here's a current measure as of the 7th. Markets have come down a little bit, but we're still expensive compared to history. Some high growth companies are more expensive than others, but it's not that concerning, and I think the economy will probably be okay. But if we end up having a mild recession, that's okay also. Again, we don't think there's a recession on the table, and certainly not one like 1973, 2000, or 2008. But pullbacks are very normal. So take a look at this. In any given year, there's a 57% chance that you have at least a 5% pullback. 10% pullback is 37%. 15% is 27%. So 1 in 4 years, okay? And a 20% pullback 1 in 5 years. Those are all very normal. So we tell clients we think pullbacks of 15 to 35% are very normal, and they happen from time to time. We're currently down maybe 9% or so in this with the tariffs and everything else going on. It's not a big deal. It should not be a big deal for your portfolio. And we design all portfolios with our planning software so you can withstand market volatility, because this is very normal. Pullbacks like these big years are not that normal. Here is another detailed slide with intra-year drawdowns, and it's very normal for stocks to have drawdowns. So you can see right now we're in the middle of 8.6% drawdown. Many of these years have 8, 10, 25, 30% drawdowns within the year. But look at how many years are green. I mean, take a look at this. It's a lot of years. We want to be good long-term investors, and we have to build a portfolio that weathers the ups and downs of your portfolio to meet your long-term growth goals and your financial plan. So take a look at this slide, and it's important to understand that we will have drawdowns, and a lot of those times they can be 10, 15, even up to 35%, and that is fairly normal. Keep that in mind. When you think about fixed income, here's an interesting chart. We're currently about here, which implies a forward return for intermediate term bonds of around 4.7%. That sounds good, except for in a taxable account, it's obviously much less because you have to pay taxes on that. So even if you have money in a money market account earning 4%, you're barely beating inflation with those numbers. So current yield of 4.7%, less taxes as your net return, less inflation, you're barely making any money net of inflation in a taxable account. So keep that in mind. So overall, hang in there. We will have volatility. It will get sorted out. Companies will adjust. Governments will adjust if we have tariffs or if it's all negotiating tools. And eventually the economy and the consumers all rebound. They retrench. They adapt to the new normal. So we have great planning software to help make sure you're on track and to give you confidence about your plan. So schedule a time with myself or Sam. We can help you work through that and give you great feedback and modeling for recessions and your portfolio, your savings rates, everything like that. And we want to help you to live your best life possible. So give us a call if you're a current client, if you're looking at us or found our blog and you want a second opinion, book that on our calendar and we will go from there. So hang in there. This will create opportunities, and it will, down the road, result in upward movements for markets and good long-term returns. Thank you. We will talk to you soon.